It's okay to break even on some deals. It's okay to take a slight loss of your capital to just get your money back out so that you put it back in your bank account and you can go do something else with it. Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to the quick solo episode here on the Multifamily Wealth Podcast. In this episode, I want to chat about an uncomfortable topic, one that I think a lot of investors out there, whether they're in multifamily or a different asset class, are probably thinking about, and it's probably a challenge for some folks, and that is, am I over leveraged? Do I have too much debt on my portfolio or on this specific project? And how should I think about either A, holding on to, or B, moving on from a deal that maybe isn't going according to plan, or that I just have a high loan balance on and that is challenging to operate as a result? So I'm going to define a few different scenarios here because I want to kind of set the stage as it relates to who I'm trying to talk to in this episode. Let's use scenario one. You are somebody who bought a multifamily property that's small to mid-size, or even kind of small to slightly larger than small, which I'll define as 2 to 15, 20 units. And you bought it in the last couple of years, or you refinanced it in the last couple of years, regardless of how long you've owned it. And you took on a new loan balance at a high appraisal, at a high, you basically took on a significant amount of debt relative to the property, whether it's on the buy side or on the appraisal side. And given the smaller nature of the property, maybe there's some units that still need to be renovated. Maybe when you have 2 tenants leave, you're basically breaking even on your debt service. If you have a few tenants leave, you're basically negative. And the property isn't necessarily one that is self-sustaining in that you can stack reserve capital to put aside to fund problems at the property level, whether that's a failed heating system, whatever. And you're kind of in that weird limbo of, I'm feeding this property. Maybe it's in a rougher area. It's got smaller bedroom counts in the units, so you have a lot of turnover, and you're constantly dealing with a couple of vacancies, and you're never really taking any money off the table here. And it's constantly calling cash in terms of you need to be continually contributing cash. That's one scenario, which is a little oddly specific, but one that a lot of smaller multifamily investors face, especially those that do their own deals with their own capital. Now, let's say you bought, scenario B, you maybe bought a small multifamily property, or you have like a single family property or something along those lines. That is in a nice area. It's more expensive on a per unit basis. Let's say you got a duplex in a nice A-class location or A-quality location. The rents aren't necessarily at that 1%. They're slightly below, but you have quality tenants. They're going to stay a while. They're always going to pay. But you're still kind of a break even on your debt service because it's not necessarily a cash flowing asset. It's one that's probably meant to be owner occupied, or it's meant for somebody who's just looking to invest capital. They're not necessarily looking for a significant cash on cash return, but they want to get their money into a quality piece of real estate. A lot of people have done deals like that as well. Last scenario that I'll paint here is you just have too much debt across the board, even if your properties are stabilized. And let's say you refied because you wanted to pull cash out, because you wanted to go do another deal. You refied a year ago. Your rate's in the mid 6s, high 6s. So it's maybe slightly lower than what it would be today, but you still kind of caught it on the upswing as it relates to when rates started to rise. And you still have a high loan balance, but you're a little nervous around the cushion here in case values start to come down. And maybe you're in one of these high supply markets and rents are starting to come back and starting to get a little nervous, starting to sleep a little bit more poorly at night. What do you do here, right? And I'm just going to share some general thoughts on this because this is a question that I get a lot from any number of individuals that fall within these 3 buckets. If you are in a cash flow neutral or negative position with a project or within your portfolio, the first place that you should look is on the operation side. Are my rents where they should be? Are my expenses too high? Are there any opportunities for me to increase the NOI either within a property or within the properties that I own, and therefore increase my cash flow and debt service coverage ratio? That should be step one, right? You need to make sure that the properties themselves are optimized so that you're removing the number of variables that you need that are present for you to make a decision. So let's say you got a bunch of properties, or you got a bunch of units. You've owned these. Let's just use a one building example. You've owned this building over the last 5 years. You've renovated all the units. It's not necessarily requiring a significant amount of capex, but you refied a year ago, you renewed a bunch of leases, and your rents are still 10, 15% below market. Maybe they should be at 1,600 and they're at 1,400 or 1,425 or 1,450. That's a fairly large delta between current rents and where they should be. And again, we always, we're revenue focused in the multifamily real estate game. Incremental increases in revenue drop straight to the bottom line because most of your expenses are fixed. So regardless of what your rents are, typically your expenses are going to be the same. So it's really important that you optimize your rent roll. So let's say this is a cash flow neutral property. You're not feeling comfortable with owning it. You feel like you might have too much leverage. You're worried about there being some significant capex item that's going to call a bunch of cash, from your own personal bank account. Should I sell it? Should I hold on to it? What should I do? Well, the first thing is, again, look at the rent roll. Can we get these rents closer to market? That should be step one. Let's optimize the rent roll. Maybe that answers the question for you because you've now increased your debt service coverage ratio and you no longer feel that stress. Now, let's use a different example of the same scenario. Your rents are at market, but you're working with a PM company, for example. So your decision here is I'm not making that, I'm not taking that much cash flow home. I'm basically just servicing my debt. Should I sell? Should I refine it? Like, what should I do? Well, let's say you're paying a property management company too much money. Let's say you have a 15-unit asset and you're paying them 10% or something along those lines because you have a long-term relationship with them and you started working with them 3-4 years ago. You haven't negotiated the price. You haven't shopped around management, etc. Well, let's say you remove that expense line item from the P&L. What does your cash flow look like? Let's say you reduced it. If you paid 7 instead of 10, or you came up with some creative solution, what does it look like? Let's say you have a management company that just does the leasing for you, but you do all the property management work, right? And you start to take some of that ownership back. What does it look like? Again, optimizing property performance at the NOI level might answer some of these questions for you. Let's put that aside. Let's say that you've already done all of these different things. The property is humming from an operation standpoint, but your capital structure is wrong. You took on too much debt, etc. I personally believe in the power of just moving on from a project or a situation that doesn't necessarily have a clear roadmap to success in the short term that is causing stress, pain, or financial instability in the moment. So in this situation, you have this property optimized. It's just your rate's too high. There's not really a roadmap to improving the property level operations. Your debt balance is a little too high. Refinancing isn't really an option because you're going to have to go bring more capital. Some people are really allergic to the idea of selling and either breaking even or even just losing a little bit of money. That's a whole nother topic for another day, but I would much prefer personally if I have a project where I have no real clear roadmap to improving the operations, and I feel like it's going to become a bit of a drag on the overall portfolio or on my time, I would rather just move on from that and put the money in the bank that I cash out with at closing, find a better opportunity for that money. When you think about the conceptual decision-making process around holding a piece of real estate, every day you decide not to sell, you are deciding to buy that property at the same price that you could sell it for minus your closing costs, right? So we want to assume transaction costs here. We want to assume tax implications. But in general, the way that you should think about it is, all right, if I sold this property minus my closing costs, what would I net at closing? That's what you're deciding to buy that property for that you have within your portfolio every single day that you decide not to sell it, right? So if you are deciding to hold, there had better be some significant reason to doing so. You like the neighborhood. You can continue improving the rent roll, continue increasing NOI, etc. There's some other compelling reason for you to hold it in terms of how it fits into your portfolio structure. Now, if those answers aren't clear and you're just holding because you were told that it's good to hold real estate long term, and that's the only reason you're doing so, well, that should swing you back swing the pendulum back to the other side of maybe it does make sense to entertain a sale here, and I can redeploy this money into something that I have a more clear business plan around, where my decision is a little bit more clear as it relates to why I would be buying this or holding this property. And I think that decision is only accelerated by challenges from a debt standpoint. If your rate's high, you have no clear roadmap to increasing the value and refinancing and improving your loan product in any way, well, then you're kind of left with selling the property. And a lot of people don't like to sell because of whatever reason. They're emotionally tied to the idea of making money. They're emotionally against the idea of losing a little bit of money. But oftentimes, I would rather lose 10% of my original investment, have that cash in the bank, and then redeploy. Now, that's not something that's happening quite often. Really only had 2 deals in my personal real estate career, and they happened 5-6 years ago where I lost money in a significant fashion. It was my own money, but that was the decision-making process around that. Was why do I continue investing time, energy, and money into a project that doesn't necessarily have a clear roadmap to multiplying my capital like a new one would, and I might as well pull it out and proceed. Now, again, I want to talk about kind of overall portfolio structure here as well. If you just have too much debt across the entirety of your portfolio, again, let's think about, instead of just A or B, hold, sell, or A, B, or C, hold, sell, improve operations. Let's think about A, B, C, D, E, F, and G, right? Can I sell a part of the portfolio? Can I refinance a portion of the portfolio? Can I lever up on one specific property, which doesn't necessarily solve my leverage problem, but it allows me to at least put money in the bank that I then have to service the debt across the portfolio that I'm going to maintain the discipline to not redeploy into something else, but I'm going to leave in the bank? Can I bring in a partner? Can I actually capitalize on the ownership side versus on the debt side? Can I bring in a partner who can buy half the equity in these or something like that? And I'm giving up some upside, but I'm improving the operating account of all of these properties, right? I'm putting money in the bank. There's all kinds of different solutions that you might be able to make here that are outside of just some of these few binary ones. And for all of the people out there that have a portfolio of properties that each have individual high loan balances, instead of being so addicted to the idea of holding onto your whole portfolio, it might be a better decision to actually sell off some of the non-performing assets or the ones that you don't necessarily see a point in owning longer term, which is something that we're doing in our business right now, like trying to trim some of the fat. I'm even selling properties that we have incredible interest rates attached to that are not necessarily over leveraged or distressed in any way. But the reason being is I would rather tap into that equity and give up my 4.25% rate to put that money in the bank, because that is a significantly better use of the equity that I have, and that is converting it to cash, putting it in the bank so that I can service all of the other properties that I have still roadmap to creating value at the property level, at the NOI level. And that make a little bit more sense for our long-term plans with a portfolio and with the business. That's not necessarily speaking to the over leverage thing, but I think in general, what I'm trying to communicate here is that there's oftentimes a whole multitude of different options that are not binary in nature. Sell or hold. There's all kinds of different ways you can think about the problem solving around having a lot of debt on your portfolio or being in projects that don't necessarily make sense. If I'm going to try and communicate one really big takeaway, and unfortunately, the private real estate investing business has created this environment where if you are a GP and you lose investor capital, you're basically out of business forever and you are shunned from society. I agree with that, obviously, right? We're not doing deals where there's a likelihood that we're losing investor capital, and we're extremely diligent about mitigating that risk. Yes. And I'm going to try and talk about this with some nuance, without cannibalizing our own business. But really sophisticated investors understand that you can't make money on every single deal. And it's okay to break even on some deals. It's okay to take a slight loss of your capital to just get your money back out so that you put it back in your bank account and you can go do something else with it. That is a fine outcome, especially during turbulent market times, which is what we are currently in. Anyone who tells you they know exactly what's going to happen over the next 2 years is full of shit. There's a lot of uncertainty about where we're going from an economic standpoint, from a real estate market standpoint, from a capital market standpoint, from an availability of debt and equity standpoint. So with that being said, if you put $200,000 into a deal, it's not really going as well as you thought. You're kind of break even on, you slightly whiffed on the rents. Your debt service is a little bit higher. You're not really taking any money off the table. There's really no roadmap to seeing it get better. And if you sell, you're going to have some closing costs and you might only be able to pull 180 out of the deal and you lose 10% of your original investment. I don't define that as a terrible outcome. I would rather take 180 grand out of my 200 off the table today versus 200 in 3 years. 100 times out of 100 times. And the unfortunate reality with investing today is that the idea of losing money has become so polarizing specific to GPs investing passively, or even individuals who are investing because of ego or because of how they think things should go as it relates to the real estate market being on a run for the last 14 years, is they don't entertain that decision or that option, when in reality, oftentimes it's the best option. And as an aside, if you're an investor out there who's being capital called into a specific deal, it's very likely that, again, and I'm not going to describe every situation like this, but it's likely that you're sending good money after bad, and that at best you're further investing in a deal to where you're just going to receive capital back many years down the line when the market rebounds or the market environment changes or they're able to better execute on their business plan or get into a better loan product, etc. It's better to take a slight haircut today, take possession of your capital back, versus continuing to ride out a subpar deal and get your principal back many years down the line. That's not ideal, because during the time of when you're just trying to get your money back, there are all kinds of investment opportunities that may arise where you can invest in, and maybe you lost some capital today, but you have a chance to multiply that capital when there's a little bit more turbulence in the marketplace. So again, I'm just kind of freeballing thoughts here, but I think this is in general how I would approach deals that are either A, over leveraged, B, not going well, C, where I'm trying to think about how to allocate capital today. That's how I'm thinking about it. Now, decision-making process for GPs with investor capital, you unfortunately need to play the game that has been, with the rules that have been laid out for you, which is you can't lose investor capital or you're basically out of the business, which is kind of funny because small-time GPs are not allowed to lose capital, whereas the Starwood Capital Groups, the Blackstones, et cetera, they lose money all the time. But it's acceptable because they're large investors, right? Starwood just defaulted on a 9-figure loan for an office building out in San Francisco, lost multiple 8 figures worth of investor equity. But that's okay because they're Starwood, right? They're allowed to lose investor capital. And part of it is because they're investing institutional capital where those capital providers understand that there's a loss risk. But for small time folks, you can't really do that if you're trying to grow a real estate syndication business. And that's the game that we play as well. And we're insanely diligent about protecting our investor downside. But speaking rationally and logically and stripping emotion of this conversation, if you're in a situation where you have the opportunity to get all of your money or a large percentage of your money back versus getting some of it or just principal back or principal very small return number of years down the line, I would rather take the loss today. So hopefully this actually speaks to somebody out there. And I don't want to freeform my thoughts on this because there's so many people today trying to evaluate what to do with specific projects or with their portfolio at large. And that's kind of how we've been thinking about the decisions that we're making within our own portfolio. So if you found this episode helpful, if you know somebody that might be in a similar situation, you think this episode might be valuable to them, please consider sharing it, texting it to them, emailing it to them, sharing it on your Instagram story or on LinkedIn or what have you. Again, helps the show get noticed by more folks. That's what we're trying to do with the podcast, is help more multifamily investors make better decisions. And if you did enjoy this, please consider leaving the show a rating and a review. And again, appreciate y'all for listening, and I'll catch you guys on the next episode.